Hey everyone, welcome back. So you want to get to the bottom of Benjamin Graham's value investing principles, huh?
Sounds like it.
Well, we've got just a whole bunch of articles and websites, excerpts, all about him.
Yeah.
The father of value investing,
Mm,
mentor to Warren Buffett.
that's right.
And speaking of Buffett, whenever someone asks him
Oh,
who he thinks is the greatest investor of all time,
yeah,
he always points right back to Benjamin Graham.
he does. It's amazing.
So I think that tells you something
For sure.
about how important this guy's ideas are.
Absolutely. Let's dive in.
Okay, so first things first, like what exactly is value investing? I'm seeing some of these sources define it as just looking for stocks that are undervalued,
Yeah.
but I feel like there's got to be more to it than that.
Oh, yeah, you're right. It's not just about finding a cheap stock. It's more nuanced than that.
Yeah.
Value investing is about finding companies that are trading for less than their intrinsic value.
Okay, so like what's the difference between like sticker price and what something's actually worth?
Yeah, exactly.
Okay, so it's like finding a hidden gem at a flea market or something,
Yes.
really valuable that everyone else has just overlooked.
Totally.
But how do we actually figure out this intrinsic value thing? Sounds kind of mystical.
Yeah. It's not magic, but it does take some work.
Right.
Graham was really big on fundamental analysis.
Mm-hmm.
So looking at the company's financials,
Mm-hmm.
you know,
Right.
their earnings and assets and debt and all that good stuff to really assess like what the company's worth.
Okay, so we'll definitely get into the nitty-gritty of that later.
For sure.
But first I noticed that Graham talked about different types of investors.
Yeah.
He uses these terms like enterprising and defensive investors.
hmm
What's the difference there?
Yeah, Graham understood that not everyone has the same time, resources, or even personality when it comes to investing. And so enterprising investors are the ones that are willing to really roll up their sleeves
Oh,
and put in the time and effort to research companies, almost like running their own little stock picking business.
okay, so they're the ones poring over all those financial statements we were just talking about.
Yeah, exactly.
Hunting for those undervalued companies.
Yes.
Okay, what about the defensive investors then? Are they just kind of like taking a more hands-off approach?
You could say that, yeah. Defensive investors are much more focused on minimizing risk and achieving steady returns, even if those returns are a little bit lower. So things like indexing, which Graham actually himself recommended. He even suggested something as simple as buying equal amounts of the 30 stocks in the Dow Jones Industrial Average.
So is he saying that anyone can just kind of coast along and get average returns without putting in much effort? I mean, that seems
Yeah,
a little too good to be true.
that's where a lot of people get tripped up. Both Graham and Warren Buffett actually argue that achieving even average returns is trickier than it sounds.
Oh, really?
And a lot of people fall into the trap of thinking a little extra work will lead to much higher returns.
Right. Yeah, like, oh, I'll just spend like an extra hour or two a week doing research and suddenly I'm going to be like outperforming the market.
Right, exactly. And that's often not the case. In fact, it can lead to worse returns than just passively indexing.
Ouch. Okay, so knowing your investor type is crucial.
Yes, very much so.
But regardless of what kind of investor you are, this concept of Mr. Market keeps popping up
Yeah,
in all these sources.
it does.
So what's the deal with that?
Mr. Market.
Yeah.
It's one of Graham's most brilliant and enduring metaphors.
Okay.
Um, think of Mr. Market as this kind of allegorical figure who represents the stock market as a whole.
Uh-huh.
The catch is that Mr. Market is highly emotional.
Okay.
He's euphoric one day, driving prices sky high,
Yeah.
and then panic the next, sending them crashing down.
So he's like that friend who's always on an emotional roller coaster.
Yes, exactly. And that's the danger. Graham's point is that you as an investor shouldn't get swept up in Mr. Market's mood swings. You need to focus on the underlying value of the businesses you own, not the daily fluctuations of what's happening in the market.
Yeah, that sounds wise.
Yeah,
But also pretty hard to do in practice.
it is.
How do you actually stay grounded, when everyone around you is kind of freaking out?
It's definitely a challenge. And that's where this idea of margin of safety comes in, which I've noticed comes up a lot in these sources.
Yeah, you're telling me. Why is this margin of safety thing such a big deal?
Well, it's fundamental to Graham's whole approach. Essentially, it means buying a stock at a price significantly lower than what you believe it's worth.
Okay.
So it's like building in a buffer.
Yeah.
It's protecting yourself from potential mistakes in your valuation or from unexpected market downturns.
Okay, so let's say I think a company is worth $100 a share. I should aim to buy it for less than that, like $70, just in case I'm a little off.
That's the idea. That $30 difference is your margin of safety. It gives you that breathing room to avoid losing money, even if things don't go exactly as planned.
I'm starting to see why this is so important. You know, it's like having a financial cushion.
Exactly.
It's interesting, though, these sources actually talk about margin of safety in all sorts of areas, not just investing.
It's fascinating, isn't it? It
Yeah.
applies to so many aspects of life.
Like, for example, one source was talking about Chesley Sullenberger, you know,
So,
Sully, yeah, landing that plane on the Hudson.
right.
Wasn't that like a textbook example of a calculated risk with a built-in margin of safety?
Absolutely. Sully knew that trying to reach an airport could have been disastrous. So he chose the safer option of the river. He had that margin of safety built in, which allowed him to make that decision in such a high-pressure situation.
Okay, that's a pretty dramatic example.
Yeah,
But they also mentioned more everyday things like Toyota's approach to manufacturing.
that's right. Toyota is known for its lean manufacturing process, which is all about efficiency. But they also have backup suppliers and backup processes. So if something disrupts their supply chain, they have a plan B ready to go.
So margin of safety isn't just about like buying things on sale.
No.
It's about like building resilience and preparing for the unexpected.
Absolutely.
So what about for like the average person?
Yeah.
How does this apply to their personal finances?
Well, one of the most obvious examples is an emergency fund. It's like a financial margin of safety. It provides a buffer against job loss or unexpected expenses,
Yeah.
anything else life throws your way.
Makes sense. Yeah, it's like having that extra breathing room,
Yeah.
knowing you can kind of handle whatever comes at you.
Totally.
Okay, so we've got intrinsic value, we've got margin of safety.
Right.
Now let's get back to Graham's like bread and butter here.
Yeah.
Fundamental analysis.
Yes.
How did he actually go about like valuing companies? What were those juicy details you mentioned earlier?
Well, Graham was big on quantitative factors. And one of the key metrics that he looked at was the price-to-earnings ratio, or PE ratio, which compares a company's stock price to its earnings per share.
Okay, so a low PE ratio could mean a stock is undervalued. But like, how do you actually calculate that?
Let's say a company's stock is trading at $50 a share, and its earnings per share are $5. You just divide the price by the earnings. So $50 divided by $5 gives you a PE ratio of 10.
Okay.
Now, whether that's low or not really depends on the industry the company is in and their future growth prospects.
But it's not just about looking for the absolute lowest number.
Right,
You have to understand like the context too.
exactly. Another ratio that Graham used was the price-to-book ratio. So this compares the stock price to the company's book value, which is basically its net worth.
Okay.
And of course, he paid a lot of attention to a company's debt levels.
Right.
Too much debt can be a red flag.
That makes sense. But I also saw some of these sources mention like qualitative factors as being important too.
Yeah.
Even though Graham might not have emphasized them as much.
No.
So what are those all about?
Yeah, you're right. Modern value investors, they often go beyond just crunching numbers.
Okay.
They look at things like a company's competitive advantage, so its economic moat.
Oh, yeah.
So how well a company can defend its market share and its profits from competitors.
So like if a company has a really unique product that no one else can replicate or a super loyal customer base, that would be a good sign. What else are these modern investors looking at?
They also look at the management team. Are they competent, ethical? Are their interests aligned with those of the shareholders?
Right. Like if the captain of the ship seems a little shady, you probably don't want to be a passenger.
Exactly. And finally, they consider industry trends as well.
Okay.
Is the industry growing or shrinking? Are there any disruptive technologies on the horizon? You have to look at the big picture, not just the company in isolation.
So much to consider. A lot of these sources also mention applying Graham's principles on a global scale. Is that something that he talked about a lot?
He didn't focus heavily on it, but Graham's principles can definitely be applied worldwide.
Okay.
But there are some additional things to keep in mind.
Okay.
One source really emphasized the importance of understanding country-specific risks.
Okay.
Things like political instability
Oh.
or currency fluctuations,
Right.
even just the regulatory environment, all things that can impact your investment.
So you have to do your homework on the countries you're investing in,
Yes, you do.
not just the companies.
That's right.
What else did they mention?
Another thing they highlighted was understanding different accounting standards,
Okay.
because financial reporting isn't the same everywhere. So you need to be aware of those differences when you're analyzing a company's financials.
Makes sense. You don't want to be comparing apples to oranges or something.
Exactly.
Okay, so we've covered a lot of ground here with like Graham's approach.
We have.
But one thing I'm really curious about is how his most famous student,
Oh, yeah.
Warren Buffett, fits into all of this. He's obviously a massive success story.
He is.
But did he just follow Graham's playbook to the letter?
It's a great question, and the answer is not exactly.
Yeah.
Buffett started out as a true Graham disciple. He was very focused on what we call cigar butt investments. So basically finding those undervalued companies that maybe had one last puff of value left in them.
So like squeezing the last bit of juice out of a lemon or something.
Exactly. But as Buffett's capital grew, so did his approach. He started investing in higher quality companies even if they weren't as statistically cheap as Graham might have preferred.
Okay, so he was willing to pay a higher price for a company that he believed in.
That's right, if he believed in the quality and the long-term potential of it.
Right.
And one source mentioned that his approach now includes a key element from another famous investor, Philip Fisher.
Okay.
Fisher really emphasized high-quality businesses with strong growth potential.
Interesting. So Buffett kind of adapted and evolved over time.
He did.
But with those core principles of intrinsic value and margin of safety still guiding him.
Absolutely.
Yeah. And speaking of Buffett, what always stands out to me is like his incredibly long-term perspective.
Oh, yeah.
I mean, he's famous for saying his favorite holding period is forever.
It's true. And that ties in perfectly with the idea of intrinsic value. Buffett believes that if you find a truly great company, its intrinsic value is just going to keep growing over time.
Yeah.
Even if the stock price might fluctuate in the short term.
So he's not swayed by Mr. Market's mood swings?
Nope.
He's got his eye on that long-term pride.
Exactly. That's why he doesn't feel the need to constantly buy and sell. He's happy to let those great companies compound their value over decades.
Now, that takes some serious patience.
It does.
So as we've kind of gone through all this, what stood out to you?
Ooh, that's a great question. What about you? What really resonates with you about Graham's principles?
I think for me, the biggest thing is this idea of looking past the hype and really getting to the heart of what a company is, It's so easy to get caught up in the buzz or the fear of the moment. But Graham's principles are all about kind of taking that step back and figuring out what a business is truly worth.
That's a great point. And it goes beyond investing, too. It applies to so many decisions in life.
Yeah.
Are you getting caught up in the surface level stuff? Or are you digging deeper?
It's like buying a used car, you don't just look at a shiny paint job.
Right.
You got to check under the hood, get a history report, make sure you're not buying a lemon.
Exactly.
And just like with that car, a company can have hidden problems that aren't immediately obvious.
That's right.
That's why that fundamental analysis is so crucial.
Totally agree. Another thing that really resonated with me is this idea of margin of safety.
Yeah.
It just makes so much sense.
Yeah.
Why wouldn't you want to have that buffer to protect yourself from mistakes or unforeseen events?
Right. And we saw how it plays out in the real world, too.
Yeah.
Not just with investing. Yeah.
Whether it's having an emergency fund, a backup plan for your business, or even just leaving extra time for your commute,
Yeah.
that margin of safety can make all the difference.
Absolutely. It's not about being paranoid. It's about being prepared.
Right.
Acknowledging that the future is uncertain and building in that resilience to help you weather any storms that might come your way.
So if we were to kind of boil down, Graham's principles to a few key points for our listener, what would they be?
I would say the most important thing is remembering that price is what you pay, value is what you get.
Right.
Don't get swayed by a trendy stock or scared off by a temporary dip.
Yeah.
Focus on that underlying value.
And to figure out that value,
yes,
we need to do that fundamental analysis.
Yes, we do.
Looking at the company's financials, seeing how profitable they are, how much debt they have, what their assets are, all those clues that kind of tell us something about their true worth.
Right. All those pieces of the puzzle. And once we have a good understanding of that intrinsic value, then we bring in that all-important margin of safety.
Yes.
We're not just paying full price. We want a buffer to protect ourselves.
Exactly.
And finally, we need to know ourselves,
yes,
right? Are we the kind of investor who enjoys that hunt for those undervalued gems? Or are we more comfortable with a passive, low-maintenance approach?
It's a spectrum.
It is, and knowing our own strengths and limitations is key.
It is key. It's like anything else. Knowing yourself is half the battle.
Right.
Investing is a marathon, not a sprint.
Yeah.
We need to find an approach that we can stick with over the long haul.
Yeah. Now, before we wrap up, I have to ask.
Okay.
We've been deep in Graham's world for a while now.
We have.
So what's like one final thought that you'd like to leave our listener with? Something they can ponder, as they continue exploring value investing?
That's a good one. It's interesting. We've been talking a lot about investing in companies, but so much of what Graham talks about is really about investing in yourself.
Ooh, I like that. What do you mean?
Think about it. He talks about being a lifelong learner,
Uh-huh.
being patient and disciplined,
Right.
thinking for yourself, not following the crowd.
Yeah.
These are all qualities that will serve you well in any area of life, not just investing.
That's so true. It's about like developing good judgment,
Yeah.
a solid decision-making framework, not just about picking stocks. It's about building like a foundation for success in every area of your life.
Exactly. And one of the best ways to develop that judgment is through reading and studying,
Yeah. Yeah.
and learning from the greats who came before you.
Right.
And who better to learn from than Benjamin Graham himself?
So in a way, reading The Intelligent Investor is like making an investment in yourself.
Precisely. And it's an investment that could pay off for years to come.
Yeah.
It's not just about learning how to pick stocks. It's about developing that mindset.
Yeah.
Learning to think about risk and value and becoming a better decision maker overall.
I love that. And what's so cool about Graham's work
Yeah.
is that it's so timeless.
It is.
The markets might change, companies might come and go, but those fundamental principles of investing and really of living a good life remain incredibly relevant.
They do. So, dear listener, if you're looking for a path to financial wisdom
Yeah.
and maybe even some life wisdom along the way,
Right?
I highly recommend taking that deep dive into The Intelligent Investor.
Who knows, maybe you'll discover a bit of that enterprising investor spirit in yourself.
Maybe.
You could be the one uncovering those hidden gem companies that everyone else is missing out on.
You never know. Or maybe you'll find that the defensive approach is more your style, and that's totally fine too.
Right.
The important thing is that you're making informed choices
Yeah.
that align with your own goals and your personality.
Yeah. Exactly. There's no one-size-fits-all approach. It's about finding your own path to financial freedom and security.
Yes. And just remember, no matter which path you choose, always keep that margin of safety in mind.
Yeah.
That cushion, that buffer can make all the difference.
Right.
Not just in your portfolio, but in life.
So well said. On that note, dear listener, we'll leave you to your own exploration
Okay.
of Benjamin Graham's world.
Yeah.
We hope you found this exploration as fascinating as we have.
Me too.
Yeah.
Happy investing. And remember to invest in yourself along the way.
And until next time, keep exploring, keep learning, and keep diving deep. As you were talking about The Intelligent Investor, it occurred to me that this book is almost like a guide to life.
It is.
Not just investing.
Yeah, it goes so much deeper.
There's so much in there about cultivating patience and discipline and independent thinking. All those traits that can make you a better person, not just a better investor.
That's right. And that's one of the things that makes Graham's work so enduring. It speaks to something so fundamental about human nature.
Yeah. Yeah.
About our hopes and our fears,
Right.
our biases, our blind spots.
It's almost like he's giving us a framework for making better decisions
Yeah.
in all areas of life,
Yeah.
not just in finance. And honestly, in a world that's so full of noise and distractions,
It is.
I think that's more valuable than ever.
I couldn't agree more. It's all about cutting through the clutter and focusing on what matters.
So for you, dear listener, if you're serious about building wealth and making smart choices, diving into The Intelligent Investor could be one of the best investments you ever make.
It really could.
And I mean that both literally and figuratively.
Exactly. And who knows, maybe it'll spark something in you. Maybe you'll discover some hidden talent for analyzing companies or spotting undervalued opportunities that everyone else has missed.
Maybe you'll turn out to be like a natural-born value investor.
Yeah, maybe. Or maybe you'll find that the defensive approach is more your speed, and that's totally fine too.
Yeah.
The important thing is to find what works for you.
Right.
What aligns with your personality and your goals.
Exactly. There's no one-size-fits-all approach.
Nope.
It's about finding your own path to financial freedom and security.
And remember, no matter what path you choose, always keep that margin of safety in mind. That cushion, that buffer can make all the difference, not just in your portfolio, but in life.
So well said. On that note, dear listener, we'll leave you to your own deep dive
Okay.
into the world of Benjamin Graham and value investing.
Yeah.
We hope you found this exploration as fascinating as we have.
Me too. Happy investing. And remember to invest in yourself along the way.
Until next time, keep exploring, keep learning, and keep diving deep.
All right, so today we're taking a deep dive into the ideas of Benjamin Graham.
The OG of value investing.
Exactly. The Godfather, right.
Yeah.
And I can tell you're all in on this, so we're going deep.
Beyond the surface level.
Yeah, going way past those beginner books. We're looking at articles, guides, trying to see how Graham's ideas play out.
In today's market.
Right. Like, does any of this stuff even work anymore with, meme stocks and algorithms? And
all that craziness.
Exactly. But first, I guess, who was this guy?
So Benjamin Graham, he's considered
the father of value investing.
You got it. He literally wrote the book on it. And not just some theory guy. He ran his own firm, got those real-world results.
Put his money where his mouth was.
Exactly.
Now, one thing that always gets me about Graham is how he kind of flips the whole risk equals return thing on its head.
Oh, yeah. Totally different perspective.
Yeah, like he's saying the more work you put in, the less risky it actually gets.
Knowledge is power, right?
Right. And that's where his whole enterprising versus defensive investor thing comes in, right?
Yeah, like, are you willing to really dig in, get your hands dirty with financial statements? That's the enterprising path.
Like you're hunting for those hidden gems.
Absolutely. But if you're more, hey, just give me some decent returns without the stress, maybe indexing or sticking to those big, solid companies.
That's more the defensive route.
Yeah.
But he's also clear that even matching the market, like following the S&P 500, it's not as easy as it looks.
No, you need discipline.
And patience, for sure.
Yeah, when the market's freaking out, you can't just panic and sell.
Easier said than done, though, right?
Oh, for sure. And that's where this idea of Mr. Market comes in. This was totally Graham's thing. Imagine, this character.
Mr. Market.
Yeah, and every day he comes knocking at your door, wants to buy or sell your stocks.
But his prices are all over the place.
Totally driven by emotion, One day he's euphoric, sky-high prices. Next day, he's depressed, practically giving them away.
So how do you deal with that? How do you not get sucked into Mr. Market's drama?
It's tough, right? But you got to recognize he's not your buddy, not some source of truth. He's just reflecting the market's mood, and that mood...
It's often totally irrational.
Exactly. So value investors, they kind of use Mr. Market's craziness to their advantage. Buy when he's spared, sell when he's greedy.
Easier said than done, I'm telling you.
Yeah.
Okay, so we're not reacting to every little price swing. But then, how do you even figure out what a stock is actually worth?
That's where intrinsic value comes in.
Okay, hit me with it.
It's looking past the market price and seeing the real deal, what's this business truly worth?
Based on its actual performance?
Right. It's like buying a house. You don't just blindly pay whatever they're asking. You gotta look at comps, location, condition, the whole picture.
So we got to become like financial detectives digging into these companies.
You got it. And Graham, he was all about this fundamental analysis. He laid out a whole system for checking a company's financial health, looking at key ratios like price to book, price to earnings.
These are telling you if you're paying too much.
Yeah, or maybe getting a bargain. He loved those low ratios, sign of potential undervaluation.
Makes sense. Now, he also had this idea, right, about net nets.
Yes. The deep value hunter special.
Yeah, like finding companies literally trading for less than their net working capital.
It's like buy a dollar for 50 cents kind of deal.
No way.
Oh, yeah. He was a master of those statistical bargains. But even with all the analysis Graham knew, no one can predict the future perfectly.
So how do you protect yourself?
That's where margin of safety comes in. That buffer, that extra cushion.
Like if you think you can drive 300 miles on a tank of gas, you fill up at 250, just in case.
Exactly. You're accounting for the unexpected. In investing, it's that difference between the market price and what you think the company's really worth. Bigger the discount, the safer you are.
Like an emergency fund for your portfolio.
I like that. It lets you make mistakes without getting totally wiped out.
Makes a lot of sense. But let's be real. Graham's world was way different than today's market. No high-frequency trading, no meme stocks going crazy.
Yeah, he didn't have to deal with all that.
So do his ideas even still work? Like, are they relevant in this wild west we got now?
$1 million question, right? But here's the thing. The market's changed, sure. But human nature, fear, greed, all that.
Still the same old story.
Exactly. And that means Mr. Market, he's still out there. Maybe even more manic than ever.
So Graham's principles, they still matter.
Big time. In fact, they might even be more crucial now. With all the noise, the hype, easy to lose sight of what truly matters.
So Graham gives us that framework, helps us cut through the
You
BS.
got it. Focus on the fundamentals, make rational decisions, even when everyone else is losing their minds.
Okay, I'm starting to get the power of this stuff, but I feel like we're just scratching the surface here. Like, how do you actually put these ideas into practice? What's next? So we've got the basics down, right? Like intrinsic value, Mr. Market, all that. But it's not just about crunching numbers, is it? Graham was big on understanding the whole picture, like what makes a business tick.
Yeah, numbers are a starting point, but they don't tell the whole story. Graham, he wanted you to dig deeper, see the company's landscape, who's running the show, what's their long game.
So we're looking for companies with like staying power, right?
Exactly. He called it a moat, a sustainable advantage. Like what protects their profits from the competition?
Okay, moat, I like that. But how do you actually see that in the real world? Like, what are the signs of a strong moat?
Think about a company like Coca-Cola, right?
Hmm.
Their brand, everyone knows it, global reach, huge distribution. Tough for a new player to come in and take a chunk out of that.
Yeah, that's true. It's like they built this fortress around their business.
Exactly. But the people running the show matter too, right? Graham was big on management quality.
Oh, yeah, for sure. Even a great business can tank with the wrong people at the helm.
Right. You want to see that track record of honesty, competence, leaders who are looking out for the shareholders, who have that long-term vision.
Sounds good, but how do we, like regular investors, figure that out? We
Yeah.
can't exactly interview the CEO, right?
True. But you can look at their past performance, how they've allocated capital, how they communicate with shareholders, read those annual letters, see how they talk about the company.
Makes sense.
Yeah.
So it's not just the balance sheet, but also the people behind it. Okay, now, even with all this analysis, the future's still uncertain, right? Like, how do you handle the psychology of all this? Didn't Graham talk about that too?
Oh, he was way ahead of his time on that. He knew that even smart people, they can get tripped up by fear, greed, all those biases.
Yeah, our brains can mess with us big time.
Totally. He wanted investors to be aware of those tendencies and develop ways to, overcome them.
So it's not just being smart, but also having that mental control, right? Like, what are some of those biases he talked about?
One big one is anchoring bias. Like we get stuck on a piece of info, even if it's not relevant anymore. Say a stock's previous high price doesn't mean it's going back there, right?
So don't get hung up on the past.
Yeah, got to focus on the future potential. Then there's confirmation bias. We tend to look for info that confirms what we already believe, ignore stuff that contradicts it.
Like we're putting on blinders.
Exactly. Can make you hold on to losers for too long or miss out on good opportunities.
So, got to challenge our own assumptions.
Big time. And then, of course, there's the herd mentality. We see everyone buying something, we jump on board too.
Safety in numbers, right?
Well, not always. In investing, the crowd is often wrong. Takes guts to go against the grain.
Easier said than done, though.
Yeah.
Especially when everyone's making money except you.
True, true. That's why Graham was so big on temperament. He said the intelligent investor is patient, disciplined, not swayed by every market swing. It's a long game.
Like that Zen approach, you know?
Exactly. He believed the market is ultimately a weighing machine, not a voting machine. Short term, emotions drive things. Long term, real value wins out.
I like that. But even with the right temperament, you can still mess up, right?
Yeah.
Nobody's perfect.
Oh, absolutely. Even the best investors have losing trades. What matters is learning from those mistakes, adapting, staying focused.
So resilience, being able to adjust, that's key too.
Now remember Graham's enterprising versus defensive investors. He knew not everyone's got the time or stomach to be digging for those deep value plays.
So for those who want a simpler approach, he suggested index funds.
Exactly. A good option for those who don't want to do all the stock picking legwork. But even with index funds, you still need discipline, long-term thinking.
Not about chasing those quick gains.
No, sir. Have a plan. Stick to it. Ride out those market storms.
Now, we got to talk about Warren Buffett, right? Graham's the most famous student. Took those teachings and built a massive empire. How did he do it? Like, did he just refine Graham's methods, or did he branch out in totally new directions? So, Buffett takes these ideas and, like, supercharges them, right? Did he just tweak Graham's methods or go off in a whole new direction?
More like an evolution, Like
Huh?
we were saying, Graham, he was cool with those cigar butt stocks. Statistically cheap, even if the companies themselves weren't that great.
Get that last puff of value, even if it's a little...
Proggy, yeah.
Exactly. But Buffett, he kind of moved towards those higher quality businesses over time, right? Companies with a real future.
The ones with those long-term competitive advantages, yeah.
So he was willing to pay a bit more as long as the price was still right.
Makes sense. He wasn't abandoning value, just, refining it.
I guess part of it was just the scale he was working with,
Yeah.
right? Like at Berkshire Hathaway, you can't just buy a bunch of tiny companies and expect to make a dent.
Exactly. He needed those bigger players to really move the needle. That's why I said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
So he wasn't ditching value, just adapting it to his situation. Now, this brings up a good point, right? Like, how does value investing stack up against other strategies, like growth investing? I know our sources said value has actually done better over time.
Yeah, there's a ton of research on that. They call it the value premium. Basically, value stocks tend to beat growth stocks in the long run.
So even those cigar butts can pay off big.
They can, but might be a bumpier ride. Shows you there are different ways to do value. Some folks go all in on a few super undervalued companies, others spread it out more. Depends on your risk tolerance, your goals, all that.
So many paths up the mountain.
You got it. Now, we got to see this stuff in action, right? Like real world examples. Our sources mention Seth Klarman, Big Graham disciple, and his investment in Idenix Pharmaceuticals.
Oh yeah, what was the story there?
So this was back in 2010. Idenix, they were developing a hepatitis C drug. Stock was down because of competition. But Klarman, he saw something others missed.
He saw the potential.
Yeah, he thought the market was undervaluing the company big time. So he goes and buys a huge chunk of Idenix, like 35%, for around $107 million.
Wow, that's a big bet.
It was. But then a few years later, Merck comes in and buys Idenix for, get this, $3.85 billion. That's over 10 times his original investment.
No way. Talk about a home run.
Textbook value investing, spotting that hidden gem everyone else overlooked. And our sources mention another great example, this one from Buffett's early days.
Oh yeah, I think I read about this one. Wasn't it American Express?
That's the one. Back in the 60s, they had that scandal, stock price tanked, everyone was panicking, but Buffett, he saw it differently.
He didn't get swept up in the fear?
Nope, he looked at the fundamentals. The scandal was bad, sure, but it didn't destroy the core business. Strong brand, solid competitive advantages. It was a bargain.
So he bought in big, and I bet it paid off handsomely.
You know it. American Express stock went on a tear over the next few decades. Huge win for Buffett and Berkshire Hathaway. Shows you, sometimes those market freakouts, those are the best buying opportunities.
Got to keep your head when everyone else is losing theirs. Now, I'm curious, do these principles work outside of just the stock market? Our sources had some interesting examples.
Oh, for sure. Margin of safety, that's a universal concept. Think about that miracle on the Hudson landing. Captain Sullenberger, he could have tried to make it to an airport, but he chose the safest option, landed on the river. That extra margin, that saved lives.
Wow, that's powerful. Didn't our sources also talk about Toyota? Like their manufacturing process?
Yeah, Toyota's all about efficiency, their lean manufacturing system. But they also get margin of safety. They have backup suppliers, backup processes. Came in handy during that 2011 earthquake and tsunami in Japan. When everyone else was scrambling, Toyota was able to bounce back quick.
Because they had that cushion built in.
Exactly. Shows you these principles, they apply everywhere. Investing, manufacturing, even flying a plane.
So for those of us ready to dive into Graham's world, what are the big takeaways? How do we put this stuff into action?
First off, remember, value investing, it's a marathon, not a sprint. Takes patience, discipline, thinking for yourself. It's about slow and steady wins the race. Do your research, learn to read those financial statements, figure out that intrinsic value.
Don't just jump into anything.
Right. Look for that margin of safety, your protection against the unexpected. Be a smart shopper, not an impulse buyer. Hunt for those hidden gems and don't be afraid to go against the crowd when you see a real opportunity.
Love that advice. So it's not just about following some formula, right? It's about understanding the principles, making them your own.
Exactly. It's a journey. You learn, you adapt, you get better over time.
And I think what's really cool is that Graham's legacy, it goes way beyond just specific techniques. It's a whole philosophy, a way of thinking that helps investors make smart choices, even when the market's going crazy.
He famously said, the intelligent investor is a realist who sells to optimists and buys from pessimists.
So as we wrap up here, I want to leave you with a challenge. Where do you see those opportunities today? Where can you buy from the pessimists, sell to the optimists? What hidden gems are out there just waiting for someone to discover them? Those are the questions that can lead you to your next great investment.
That's what it's all about. We've given you the tools. Now go out there and make some magic happen.
Happy investing, everyone. Hey everyone, and welcome to our deep dive. We're tackling Benjamin Graham and his value investing principles today.
Yeah, he's a legend, right?
Absolutely. And we've actually gathered up quite a collection of resources for this one. Articles, book excerpts, even some stuff we found online.
Oh, wow.
All about Graham, his strategies, how he made his mark.
Cool.
But we're not stopping there. Nope.
Oh.
We want to see how these ideas, they can help you, especially in today's market.
Right, because things have changed, right?
Definitely. But some things, they stay the same.
Yeah.
And that's the cool part. It's this journey, from those early Wall Street days to, like the strategies that are shaping the biggest investors right now.
So are we talking like a historical deep dive and a practical guide?
Kinda. Both rolled into one. Because what's fascinating is Graham's ideas, they might seem old school at first glance, but they're incredibly relevant today.
You really think so?
Especially when you compare them to all this like flashy growth investing stuff that's, all over the place.
Ah, I see.
We're going to unravel those differences too, so you can decide which approach actually clicks with your investing style.
Love it.
So to kick things off, let's just like set the stage a bit.
Yeah.
Most of you probably know Benjamin Graham as like the father of value investing.
Yeah.
And of course, as Warren Buffett's mentor, which Buffett himself, he constantly praises Graham as the greatest investor ever.
High praise indeed.
It is. But what did Graham actually do that was so groundbreaking? What's the big deal?
Well, think of it this way. Graham didn't just play the market. He kind of wrote the rule book. Like back in 1934, he published Security Analysis.
Right.
And then 1949, he released The Intelligent Investor. Both books, they're practically required reading for, anyone serious about investing.
Classics.
They really are. Think of them as like the original guides to understanding how businesses actually work and then how to put a price tag on them, like how to value them.
It's interesting because he didn't just talk the talk.
Oh.
He walked the walk big time. He co-founded this investment partnership, Graham Newman, and they consistently beat the market for over 2 decades.
Wow. 2 decades. That's not just luck.
Not at all. That's having a system, a solid one.
And that system, it all starts with, understanding yourself as an investor.
That's awareness, huh?
Graham was really big on that, knowing what kind of investor you are before diving into the market. He even, categorized investors.
Oh, yeah. How do you do it?
Enterprising or defensive.
I've heard those terms.
Yeah.
So is it kind of like active versus passive?
Exactly.
Interesting. So in his book, Benjamin Graham's Timeless Investment Principles, he goes into this idea that the more time and effort you pour into actually researching, understanding your investments, the greater your potential returns could be. So he basically flipped that whole traditional risk equals reward thing.
Oh, how so?
To work equals reward. The harder you work, the more you can potentially earn.
Interesting. And I bet this self-awareness, it plays a huge role in picking the right strategy for you.
Huge. Like it helps you match your investment strategy to like your time commitment.
Right, all right.
How comfortable you are with risk. And even just like how hands-on you want to be. If digging through company financials for hours isn't your thing.
Yeah, some people find it tedious.
Maybe a more passive approach makes sense, like indexing. Basically buying a basket of stocks that represent, the whole market.
Yeah.
Graham actually suggested that for his defensive investors.
Makes sense. But I think even with that, like achieving even just average market returns, like matching the S&P 500, it can be trickier than people think.
Oh, absolutely.
A lot of people have this idea, right? Well, if getting average returns is so easy, I just passively track the market, then surely putting in a bit more effort should get me like slightly higher returns, right?
Yeah, it's easy to fall into that trap. I can beat the market by just a little bit if I just try a little bit harder.
And that's where it gets dangerous. Because studies actually show that most people trying to do that outperform by just a small margin. They end up doing way worse than average. To be a successful active investor, it takes real commitment and work.
No shortcuts. So let's say someone is ready to put in the work. What's the most important thing they need to grasp about Graham's approach?
Hands down, the concept of margin of safety. It's the bedrock of his entire philosophy. What sets value investing apart?
We've got some great resources to help break this down. Margin of safety, a simple explanation, margin safety, the lost art, Even some real-world examples from Faster Capital, just like in a nutshell.
Okay, imagine a bridge, right? It's engineered to handle way more weight than it will ever actually carry, that extra capacity. That's its margin of safety.
I see, I see.
So in investing, it's the difference between a stock's intrinsic value, like what it's truly worth based on its fundamentals and its market price, what people are currently trading it for.
Got it.
And buying a stock below its intrinsic value, that creates that same buffer, that same safety net.
Protection from the unknown.
Exactly, because no investment is foolproof, right?
Right.
Okay. Margin of safety, it protects you from, well, maybe you're wrong in your analysis,
Yeah.
or some unexpected bad news hits, or even just those, crazy market swings that seem to come out of nowhere.
Oh, yes. Speaking of market swings, Graham had this brilliant analogy he called Mr. Market. Introduced it in The Intelligent Investor.
Oh, Mr. Market, yeah.
And so who is this Mr. Market exactly?
He's like this unpredictable character, shows up every day representing the stock market's mood.
Interesting.
Some days he's euphoric, other days total downer. He's constantly trying to buy your stocks low or sell them high based on, well, his emotions.
So he's basically like trying to get you to react based on his feelings about the stock.
Exactly, rather than what it's actually worth.
Tempting.
They can be. But a savvy investor, a Graham-style investor, they don't let Mr. Market's daily mood swings, dictate their decisions.
So instead of trying to time the market,
You focus on understanding the real worth of the businesses, the fundamentals.
tune out the noise. Got it. Okay, so we've talked about looking for these undervalued companies. But what actually makes a company undervalued? What did Graham actually look for?
Well, we've got a great resource that breaks down some of his criteria. Benjamin Graham's 7 ways to select high-value stocks.
Perfect.
And Graham, he was a big believer in both quantitative and qualitative factors, like a detective looking for clues.
I like that analogy.
Yeah. On the quantitative side, he'd look at things like a company's financial stability, manageable debt levels,
Makes sense.
consistent earnings growth, and how its stock price compared to, key metrics.
Numbers. But it's important to remember, Graham was writing in a different era.
Oh, absolutely.
So while these quantitative factors are still important starting points, we have to analyze them, like in the context of today's market.
Absolutely.
For example, Graham really liked companies with a low price-to-book ratio.
Yeah, that one's a classic. Compares a company's stock price to the value of its assets on its balance sheet.
Refresh my memory on what that really tells us.
Okay, imagine you're buying a house. You'd compare the asking price to the value of the land, the building materials, everything inside. If the price is way lower than the value of all those assets, you might have a steal on your hands. So Graham used that same logic with stocks. Looking for steals.
So a low price to book could be a sign the market's undervaluing a company.
Yeah.
But you can't just blindly compare any two companies using just this one metric, right?
Right. Different industries, they have different average price-to-book ratios.
Right. So a hot new tech company, it might naturally have a higher price-to-book ratio than like a stable utility company.
And that doesn't mean the tech company is overvalued.
Right.
It just means investors are expecting higher growth from that tech company in the future. And that's where understanding the qualitative side of a business, it becomes crucial. Looking beyond just the numbers, understanding what's driving them.
Okay, so we're not just crunching numbers. We're also considering things like the company's management, their competitive advantages, and the whole industry landscape.
You got it. We got to ask, are the company's earnings sustainable over the long term? That's key. To figuring out if a cheap stock is actually a bargain or if it's cheap for a reason.
It reminds me of something from Lessons and Ideas from Benjamin Graham, Jason Zweig, where he mentions this belief that most investors can't count beyond 3.
Oh, I love that. Classic Graham.
What he meant was investors often get carried away by short-term trends.
Right.
Like they extrapolate those trends way into the future without even thinking if they're actually sustainable.
Right. It's like saying, hey, this company had a couple good quarters, so obviously they're going to be a rocket ship forever.
Exactly.
But what if those earnings were just a fluke, a one-time thing? We got to dig deeper, separate the signal from the noise, see if those good times are built on a solid foundation.
Okay, so how do we do that? How do we determine if a company's earnings are truly sustainable? What are the signs we should look for?
One of the most important things is looking for what Warren Buffett calls a moat. That's a durable competitive advantage that makes it hard for other companies to, steal market share.
And eat away at profits.
Exactly. And mastering value strategies. Insights from Graham to Buffett, they had some great examples of what these moats look like in the real world.
Oh, yeah. Give me some examples.
Okay, some companies have incredibly strong brand names. Think Nike, Disney. Customers are fiercely loyal to those brands.
Makes sense.
Others, like Walmart, they have massive economies of scale, so they can offer lower prices than their smaller competitors.
Right.
And then some, like pharmaceutical companies, they have patents that give them, exclusive rights to sell certain drugs.
So all of these things, they make it difficult for new companies to, enter the market and compete.
Right. Which helps protect those profits over the long haul.
Okay, so moats are good. But even if a company has a wide moat, it doesn't guarantee success, does it?
Nope, not at all. A bad management team can still make decisions that ruin a perfectly good business.
So even if we find a company with a great product, a dominant market position, we still need to look closely at who's running the show.
Absolutely. Management quality was crucial for Graham. He looked for leaders who were honest, competent, and had a proven track record of, well, making decisions that benefit shareholders.
And we could evaluate that, right?
Oh, yeah, by looking at their past performance, how they've allocated capital, how transparent they are in communicating with shareholders.
We're playing detective, looking for clues about whether management is going to, steward the company well and create long-term value.
Exactly.
Now, after all this analysis, the financials, the competitive position, the management team, then we can start trying to figure out intrinsic value.
The big question.
But there are different methods for doing this, right? And some of them, they can seem pretty complex.
One common approach is called discounted cash flow analysis.
That's a mouthful.
It can seem intimidating at first, but the basic idea is actually pretty simple. It's all about understanding the time value of money.
Okay, explain that one to me like I'm 5.
All right. Imagine someone offers you $100 today, or $100 a year from now. Which would you choose?
I'd probably take the $100 today.
Exactly. A dollar today is worth more than a dollar tomorrow, because you can invest that dollar today and, well, potentially earn a return on it.
Okay, yeah.
Discounted cash flow analysis, it applies that same principle to companies.
So we're trying to figure out what a company's future earnings are worth today.
Right. Taking into account that those future earnings are less valuable than, earnings we get right now, we're basically trying to predict how much cash the company will generate in the future and then discount those future cash flows back to their present value.
Okay, and I'm guessing making those predictions about the future involves, a lot of assumptions and estimates.
It does. You got to factor in things like revenue growth, profit margins, capital expenditures. It's not an exact science, but it can give you a reasonable ballpark estimate of what a company might be worth.
Importance of the margin of safety in stock valuation stablebread actually gave an example that used a spreadsheet to test different assumptions.
Oh, that's a good one. It helps you see how different factors can impact a company's potential value, get a sense of the range of possible outcomes.
Right, but even after all this analysis, we're not trying to pinpoint intrinsic value, with perfect accuracy, are we?
Even Warren Buffett says he doesn't try to calculate it down to the penny.
Really?
He just wants to be roughly right and make sure he's getting a good deal.
So it's more art than science.
To a certain extent, yes. It's about finding those companies where the value is so obvious, so clear, that you don't need a super sophisticated model to tell you it's a good deal.
Like finding a $20 bill on the sidewalk.
Exactly. You don't need a calculator for that. You just pick it up.
It's about having that aha moment, seeing potential the market is missing. But finding those undervalued companies is only half the battle, isn't it?
Oh, tell me about it. Knowing when to sell is just as important, and arguably even more difficult.
Welcome back, everyone. So we laid the groundwork for Graham's whole value investing philosophy, but now I'm curious about actually putting it into practice.
Yeah, the rubber meets the road.
Exactly. Especially that whole intrinsic value thing. Figuring out what a company's really worth, it seems kind of daunting.
It definitely can be, but that's part of what makes it interesting. It's not just, plugging numbers into a formula.
Oh, no.
It's more like being a detective. You're piecing together clues to figure out if a company is truly undervalued by the market.
I like that. So where do we start our investigation? We talked about those quantitative factors, right? Financial stability, debt levels, earnings growth. Those are all part of the puzzle.
Absolutely. And Benjamin Graham's 7 ways to select high-value stocks gave us some specific metrics he used, like the price-to-earnings ratio.
The PE ratio.
Yep, that's the one.
Remind me what that tells us again.
Okay, think of it like this. You're at the grocery store, you see 2 bags of apples. They both look good, but one costs twice as much. You'd naturally wonder, Why is this one so expensive? Is it twice as good? So the PE ratio, it's kind of like that, but for companies. If a company's making $1 of profit per share and the stock costs $10, that's a PE ratio of 10. You're paying 10 times earnings.
Okay, I see.
Graham loved finding companies where you were getting those earnings much cheaper, maybe for a PE of 5 or even less.
So a lower PE ratio could mean the market is undervaluing the company's earning potential.
Exactly. But, like we talked about before, we got to consider the context. Different industries have different average PE ratios.
Right. A hot new tech company might naturally have a higher PE than, like, a stable utility company.
And that doesn't mean the tech company is overvalued. It just means investors are expecting higher growth from that tech company in the future. That's why those qualitative factors are so important. We got to understand what's driving those numbers.
So we're not just staring at spreadsheets all day.
Nope.
We're also thinking about the company's management, their competitive advantage, that whole industry landscape.
You got it. We got to ask, are the company's earnings sustainable over the long term? That's key. To know if a cheap stock is actually a bargain or if it's cheap for a reason. And you know what? That reminds me of something from Lessons and Ideas from Benjamin Graham, Jason Zweig. He mentioned this thing Graham believed that most investors can't count beyond 3.
What did he mean by that?
He was being a little cheeky, but what he meant was investors often get carried away by short-term trends, right? Extrapolating them way into the future without considering if they're actually sustainable.
So just because a company had, like, a good quarter or two doesn't mean they're going to be a rocket ship forever.
Exactly. Those earnings could be a fluke, a one-time thing. Got to separate the signal from the noise, dig into the underlying business, and see if those good times are built on a solid foundation.
Okay, so how do we do that? How do we figure out if those earnings are truly sustainable? What are those solid foundations we should be looking for?
One of the most important things is looking for what Warren Buffett calls a moat.
The moat.
A durable competitive advantage. It makes it tough for other companies to steal market share, eat away at those profits.
Mastering value strategies. Insights from Graham to Buffett. Didn't they have some good examples of moats?
Oh, yeah, tons of real-world examples. Some companies, they have these incredibly strong brand names, like think Nike or Disney. Customers are super loyal.
Right.
Others, like Walmart, they have massive economies of scale. They can offer lower prices than those smaller competitors.
Makes sense.
And some, like those pharmaceutical companies, they've got patents giving them exclusive rights to sell certain drugs. All of those things, they make it hard for new companies to come in, compete.
And that protects profits.
Yeah.
Long term.
Exactly. But even if a company has a wide moat, it's not a guaranteed success, is it?
I guess not.
Nope. A bad management team can still mess things up, make decisions that ruin a good business.
So even if we find a company with a fantastic product, a dominant position, we still need to look at the people in charge.
Oh, absolutely. Management quality, it was crucial for Graham. He looked for leaders who were honest, competent, and had a proven track record, of actually making decisions that benefit shareholders.
Good stewards of the company.
Precisely. And we can evaluate that by looking at their past performance, how they've allocated capital, how transparent they are in communicating with those shareholders.
Always playing a detective, looking for clues.
Always. We want to know, is management going to steward the company well? Are they going to create long-term value?
Right. Now, after we've analyzed the financials, the competitive position, the management team,
that's when the real fun begins.
then we can try to figure out intrinsic value.
The holy grail.
But as we mentioned, there are different methods for doing this. Some of them can get pretty complex.
Yeah, one common approach, it's called discounted cash flow analysis.
Discounted what now?
It can seem kind of intimidating at first, but the basic idea is pretty simple. It's all about understanding the time value of money.
Oh, okay. Explain that to me, like as simply as possible.
All right. Imagine someone offers you $100 today, or they offer you $100 a year from now. Which one would you pick?
I'd probably go for the $100 today, cash in hand, right?
Exactly. A dollar today is worth more than a dollar tomorrow because you can invest that dollar today and potentially earn a return on it.
Makes sense. So how does this apply to companies?
Well, discounted cash flow analysis, it applies that same principle to companies. We're basically trying to predict how much cash the company will generate in the future and then discount those future cash flows back to their present value.
So we're trying to figure out what a company's future earnings are worth today.
Right. We have to take into account that those future earnings are less valuable than earnings we get right now.
And I'm assuming making those predictions about the future, that involves a lot of assumptions, a lot of estimates.
You bet. Got to factor in things like revenue growth, profit margins, capital expenditures. It's not an exact science, but it can give you a reasonable ballpark estimate. And you know what? We actually saw an example of this in importance of the margin of safety in stock valuation stablebread. They used a spreadsheet to test different assumptions, see how it affected that intrinsic value calculation.
Yeah.
That's a great way to understand how sensitive your valuation is to different factors, the range of possible outcomes. But even after all this analysis, we're not trying to get intrinsic value with pinpoint accuracy, are we?
I guess not. Seems impossible, honestly.
Even Warren Buffett, probably the most successful value investor of all time, even he doesn't try to calculate it down to the penny. He just wants to be roughly right, make sure he's getting a good deal.
It really is more art than science then, huh?
In a way, yeah.
Yeah.
It's about finding those companies where the value is so obvious, so clear. You don't need a super sophisticated model to tell you it's a bargain. Remember that $20 bill on the sidewalk?
I do.
That's what we're looking for. You don't need a calculator to tell you that's a good deal. You just pick it up. It's about having that aha moment. You see the potential that the market is missing. But finding those undervalued companies, that's only half the battle, isn't it?
I have a feeling you're about to tell me the other half.
Knowing when to sell is just as important and arguably even more difficult.
Oh, I bet. That's where Mr. Market really tries to mess with your head, isn't it?
Oh, absolutely. Whispering in your ear, sell now while you can, or buy more before you miss out.
Tempting. Very tempting.
But remember, we're not playing Mr. Market's game. We're in it for the long haul, buying great businesses that we believe will compound in value over time. And speaking of knowing when to sell, Thinking About Margin of Safety Investment Masters class offers some great insights on how to approach selling from a value investing perspective.
Well, that's a good one. What are some of the key takeaways?
One of the biggest is, sometimes the best thing to do is nothing at all.
Really? Sounds a bit passive for a value investor.
It might seem that way, but it's actually a very active decision. If you've done your research, you're confident in the long-term prospects of the business.
You've bought it with a healthy margin of safety.
Then simply holding on, even when the market's volatile, can be the most profitable strategy.
Interesting. But what if the company's fundamentals start to change? What if that moat starts to shrink? Or the management team makes some questionable decisions?
That's when you got to reassess your investment thesis, maybe consider selling. And this article really emphasizes the importance of being honest with yourself about those changes. It's easy to get emotionally attached to a stock, especially if it's been a winner for you.
Oh, yeah, definitely. Don't fall in love with your stocks. Heard that one before.
Exactly. But we got to remember, the market doesn't care about our feelings. It cares about the future prospects of the business. And if those prospects dim...
You got to be willing to walk away.
Exactly. It's better to cut your losses and move on, even if it's painful. Sometimes the best trades are the ones you don't make.
Now, this article also mentioned something called portfolio margin of safety. What's that all about?
It's the idea that you don't necessarily need a huge margin of safety in every single investment, as long as your overall portfolio has a sufficient buffer.
Okay, I'm intrigued. Tell me more.
So you might have some core holdings, those classic Graham-style value stocks you bought at a deep discount.
The bedrock.
And then you might have a smaller portion of your portfolio dedicated to more speculative investments, companies with higher risk, but also potential for those big, outsized returns.
So you're diversifying your margin of safety across different types of investment.
Precisely. But even with those more speculative bets, it's crucial to size your positions appropriately so that a few big losses don't wipe out the gains from those core holdings.
Right. Risk management is key no matter what kind of investor you are. Value, growth, whatever. Managing your downside risk is paramount.
Couldn't agree more. And remember, there's no single right way to apply Graham's principles. They're more like a framework for thinking about investing, not a rigid set of rules.
A starting point.
It's up to each investor to adapt those principles to their own goals, their risk tolerance, their time horizon.
So it's about tailoring the approach.
Yeah.
Like a tailor adjusts a suit to fit perfectly.
Exactly. But the beauty of Graham's approach is that it's so adaptable. Whether you're just starting out or you're a seasoned pro, his principles can help you make more informed, more intelligent decisions.
Value investing lessons from Benjamin Graham actually gave us some specific examples of how Graham himself managed his portfolio. I love seeing how the masters put their principles into practice.
Me too. It's fascinating.
So Graham actually suggested aiming for a portfolio of about 30 stocks.
Interesting. That actually aligns pretty well with modern portfolio theory.
Oh, yeah. Remind me what that is again.
So modern portfolio theory, developed by this economist, Harry Markowitz, it basically says that by spreading your investments across different assets, you can reduce your overall risk without sacrificing returns.
The classic, don't put all your eggs in one basket idea.
Exactly. And a portfolio of around 30 stocks is often considered a good starting point for achieving that diversification benefit.
Now, I think Graham also had some specific rules for when to sell, right? Like, if a stock didn't reach his target price within 2 to 3 years.
Right. He wasn't afraid to cut his losses and move on if an investment wasn't working out. Understood that holding on to losers can really drag down your portfolio's
Makes
performance.
sense. Didn't he also say something about always having at least 25% of your portfolio and some combination of stocks and bonds?
He did. It's a good reminder that asset allocation is key for managing risk and achieving your long-term goals. Stocks, they offer higher potential returns, but also higher volatility. Bonds tend to be less volatile, but offer lower returns.
It's all about striking that balance, risk versus reward.
Exactly. And Graham even talked about adjusting that asset allocation based on market conditions. If there were a lot of great value stocks available, he'd increase his stock allocation up to 75%. But if the market seemed overvalued and bargains were scarce, he'd reduce his stock exposure to 25% and hold the rest in government bonds.
That's smart. It's like he was a contrarian investor, not just blindly following the crowd, but making decisions based on his own analysis.
Precisely. He understood that the market can be irrational in the short term. Sometimes the best thing to do is go against the prevailing sentiment.
So we've seen how Graham's principles can be applied to both individual stocks and the overall portfolio.
Right, it's a holistic approach.
Diversification, risk management, discipline in both buying and selling. Important stuff.
And his ideas, they've stood the test of time. Look at Warren Buffett.
Definitely a testament to Graham's influence. But we've also seen that even those timeless principles need to be adapted as the market changes.
Of course. The specific techniques, the ratios, those might need some tweaking, but the underlying philosophy, finding value, managing risk, thinking for yourself,
The fundamentals.
those remain incredibly relevant even in today's market.
And one of the articles actually shared some modern-day examples of companies that have benefited from this value-driven approach. Always inspiring to see how it plays out in the real world. It connects the dots, between the theory and the practice.
For sure.
For example, they highlighted Berkshire Hathaway itself. Warren Buffett built it from a struggling textile company into a massive conglomerate, using Graham's principles as a foundation, a testament to the power of long-term thinking.
Amazing story.
And speaking of Buffett, they mentioned his investments in companies like American Express and Coca-Cola. He bought them at prices significantly below what he believed they were worth.
Classic value investing. And look at them now. Those investments have generated incredible returns for Berkshire Hathaway shareholders. Buffett's patience, his discipline, combined with that ability to identify undervalued companies, it's remarkable.
They also brought up the 2008 financial crisis. Obviously a wild time for the market.
Yeah.
But amidst all the panic, Buffett used his cash pile to buy stakes in companies like Goldman Sachs and General Electric when their stock prices were plummeting. He saw opportunity.
He understood that when fear grips the market, even great companies can be mispriced. Creating those incredible buying opportunities, you got to have courage to act in those moments.
And his patience paid off as those companies recovered. It reminds me, staying calm and rational during those times of turmoil, it can be incredibly profitable.
It's not easy though, is it?
No, it takes real discipline. Now, before we move on to the final part of our deep dive, I think it's important to touch on some of the potential downsides of value investing, some of the criticisms. No investment strategy is perfect. Value investing definitely has its challenges.
Of course, no approach is foolproof. Got to understand those potential downsides before diving in head first.
One of the most common criticisms is that value investing can be slow. It requires a lot of patience.
True, true. Value stocks, they don't always go up immediately after you buy them. Sometimes it takes years for the market to recognize their true worth. And that can be frustrating, especially if you're looking for those quick gains.
Or if you have a shorter time horizon.
Right. And then there's always the risk of falling into what's called a value trap.
Oh.
That's where you buy a stock that seems cheap, but it actually has fundamental problems that prevent it from ever recovering. Sometimes that low price is a warning sign, not a bargain.
So it's about figuring out why the company is trading at that low valuation. Is it just temporary, or are there deeper issues?
Exactly. Got to distinguish between those companies that are temporarily undervalued and those that are permanently impaired.
I see.
Yeah.
And even if you're right about a company being undervalued, There's no guarantee the market will agree with you, right?
Nope, not at all. The market might not come around for a long time. Your investment could languish, maybe even decline further in the short term. And that's where the psychological pressure comes in. It's tough to hold on to an investment that's not performing as you expected.
Doubt can creep in.
It can. And that's why it's so important to have conviction in your research and to have that margin of safety to protect you in case things don't go exactly as planned.
It's like having that cushion, right, to absorb those bumps in the road.
The margin of safety is your friend. Value investing, it's not about being right all the time. It's about minimizing your losses when you're wrong and maximizing your gains when you're right.
And that takes discipline, patience,
Yeah.
a willingness to, think independently, go against the crowd if you have to.
It's not always easy, but for those who embrace those principles, value investing can be an incredibly rewarding approach to building long-term wealth.
So we've talked about putting Graham's principles into practice, analyzing financials, identifying competitive advantages, understanding management quality, calculating intrinsic value. We've also talked about some of the challenges, those potential downsides, right?
The importance of patience, discipline, risk management.
And we've seen those real-world examples of how this approach has created fortunes for those who embraced Graham's wisdom. But our deep dive's not over yet. In the final part, we'll explore how Graham's ideas have evolved and been adapted to today's market, and we'll even look at some specific sectors and industries where value investing might be especially well-suited. All right, welcome back for the final part of our deep dive. Benjamin Graham, value investing, all that good stuff.
We've covered a lot of ground, haven't we?
We have. Intrinsic value, Miss Market's tricks. But now I'm thinking the rules changed a lot since Graham's time, right? Our investing strategies, they probably need to adapt to.
Absolutely. I mean, think about how much the business landscape has transformed. The
Yeah.
internet, global markets, the speed of innovation. It's a different world.
So how do we even apply these, seemingly old school principles to this new reality? What has to change? What stays the same?
Well, the key is remembering that Graham's core ideas, they're about timeless principles, not just rigid formulas. Finding value, managing risk, thinking for yourself. Those ideas, they're as relevant today as they were back then.
But maybe the specific tools, the metrics, those might need a little tweaking to fit today's business landscape.
You got it. Can't just blindly plug in Graham's ratios and techniques without considering the context of the modern market.
For example, Graham, he focused a lot on those manufacturing and industrial companies, right? The giants of his era.
Right, the blue chips of the day.
Today, it's all about tech, services, intellectual property.
Completely different game in many ways.
So mastering value strategies, insights from Graham to Buffett, they touched on some of those adaptations. For instance, with tech companies, traditional metrics like that price-to-book ratio, they might not tell the whole story.
Nope, because a tech company's real value could be in its software, its patents, brand recognition, things that are tough to quantify on a balance sheet.
So maybe we need to consider other metrics, like the price-to-sales ratio, price-to-cash flow, to really get a clearer picture.
Exactly. And, like always, those qualitative factors become even more important, especially in these industries that are constantly evolving.
We need to understand the company's competitive edge, their ability to innovate, stay ahead of the curve. Those are the signs of long-term success in tech. It takes a lot of research, digging deep, critical thinking.
Couldn't agree more. We can't just rely on simple formulas or follow the herd when it comes to, valuing those innovative companies.
It all comes back to Graham's emphasis on being an independent thinker, doesn't it? Tuning out the noise, forming your own conclusions. He was really ahead of his time in a lot of ways.
He understood that the market's driven by emotions, fear and greed. And the only way to avoid getting caught up in all that is to have your own informed perspective.
So be skeptical. Question those assumptions. Do your homework.
Couldn't have said it better myself. And honestly, that's even more important now. Think about the constant information overload we face every day. Social media, financial news outlets, all those self-proclaimed experts.
It's a lot. It's easy to get lost in the noise.
It really is. You got to develop your own filters, figure out which sources you trust and which ones are just, noise.
And at the end of the day, remember, you're responsible for your decisions. Nobody else.
Words to live by. So how about we shift gears a bit? Let me talk about some specific sectors, industries where value investing might be particularly well suited in today's market.
All right, I like it. Value investing lessons from Benjamin Graham actually had some examples that fit those Graham criteria. Companies that might be worth a closer look.
Oh, that's always fun, seeing those principles in action.
So they highlighted a few companies. One was Bajaj Holdings, the company with a long history, involved in a bunch of different businesses, primarily within the Bajaj Group, kind of like a diversified holding company. They also mentioned Natco Pharma, a pharmaceutical company, focus on bringing niche products to market at affordable prices. Sounds pretty promising, especially in healthcare. Then there was Great Eastern Shipping, India's largest private sector shipping company, a potential play on global trade and logistics. And Nava Bharat caught their eye too. It's a multinational company operating in metals, power, and agriculture. Very diversified.
Sounds like a classic conglomerate.
And finally, they pointed to Maharashtra Seamless, a leading manufacturer of seamless pipes, a potential bet on infrastructure and industrial growth.
Lots of potential areas to explore, but it's important to remember these are just examples, not like endorsements or anything.
Right. They fit certain criteria, but further research is always key. Weighing stocks with Benjamin Graham emphasized that there's no such thing as, like, an inherently good or bad stock.
It all boils down to price.
Exactly. Even the best company in the world can be a bad investment if you overpay for it. And that's where the margin of safety comes in again, right? It protects you from those mistakes, the ones we all inevitably make.
It's that cushion, that buffer, just in case things don't go exactly as planned. Because no investor has a perfect track record.
True that. So as we wrap up this deep dive, I want to emphasize something. Value investing, it's not about getting rich quick.
It's a marathon, not a sprint.
It's a long-term philosophy. Requires patience, discipline, and a willingness to learn and adapt as the world changes.
It's about building that framework for making good decisions, not chasing fads or trying to time the market.
And what I love about it is it's accessible to everyone. You don't need a fancy degree or a Wall Street background to be successful at it.
Nope. All you need is curiosity, patience, and the courage to think for yourself.
And that's the beauty of Graham's legacy. He didn't just give us a set of techniques. He gave us a way of thinking, approaching those decisions with logic, reason, and a healthy dose of skepticism. And those are tools that are valuable no matter what you do in life.
Well said.
So keep learning, keep exploring, and keep diving deep into the world of investing and everything else that interests you.
Couldn't agree more. The best investment you can make is always in yourself.
That's all for our deep dive into Benjamin Graham and value investing. Thanks for joining us. All right, so today we're going to do a deep dive into the world of Benjamin Graham.
Oh, yeah. The OG.
The godfather, right?
The godfather of value investing.
Of value investing.
Yeah.
We've got a stack of articles and excerpts all about his investment philosophies, and we're going to try to bring you the most important stuff.
I'm excited.
Yeah, I am too. This
will be good.
Yeah.
It's interesting how relevant his ideas are even today, right? Like they're baked into the system.
Baked in, yeah. But before we get into all that good stuff, maybe give us some context. Who was Benjamin Graham?
So Graham, he was born in 1894.
Wow.
He lived through like all the crazy eras of Wall Street.
Oh, wow.
Imagine, like 1914, that's when his career started.
Wow. That's a long time ago.
Yeah, and his book, Security Analysis, came out in 1934.
Yeah.
And it's considered like the Bible of investing, you know?
Yeah.
But he's probably most famous for The Intelligent Investor.
Yeah.
That one was published in 1949, and it's still a must-read, you know? For serious investors, for sure.
That's amazing. And that's where the Warren Buffett connection really blows my mind. Like,
it's crazy, right?
Yeah.
How even today, Warren Buffett still talks about how much Graham's teachings meant to him.
Oh, yeah.
Like early in his career.
It's like he's the
foundation.
The foundation, yeah. And we'll talk about how Buffett kind of evolved those principles as his wealth grew.
Yeah.
But that alone, that connection alone tells you we're onto something pretty important.
Definitely. And speaking of which,
yeah,
Graham was really known for this thing called value investing.
Okay.
But that term gets thrown around a lot, you know?
Right. Yeah.
What does that actually mean in Graham's world?
Yeah, break it down for us.
Okay, so
it's got to be more than just finding a cheap stock, right?
Yeah, it's not just about finding a cheap stock.
No.
It's more like, you know, being a detective. It's
Right.
about finding those stocks that are trading for less than their intrinsic worth. You know, and when I say intrinsic worth, I'm not just talking about today's price. It's
Yeah.
about what a company is really capable of.
Okay.
Based on its financials, its dividends, future prospects, all that stuff.
So it's like you're looking for those clues
Yeah.
that everyone else is missing.
Uh-huh.
Uh-huh.
Almost like trying to outsmart the market.
Ooh.
Right?
I like it.
Yeah, and Graham knew that not everyone has the same appetite for that kind of deep dive,
Yeah.
He talked about two types of investors.
Okay, I'm feeling a quiz coming on.
All right.
Hit us with it.
So he said there are enterprising investors.
Okay.
And defensive investors.
Okay.
And enterprising investors, they love the research.
Okay.
They're very hands-on, they're active.
Yeah.
They put in the time, and they're looking for those higher returns,
I see the appeal, but I got to say, I'm more of a set it and forget it kind of guy. What about us less adventurous types?
That's the defensive investor. They're more passive, they're looking for those average returns, but less work.
Okay.
Think index funds, diversified portfolio,
Okay.
And Graham was really clear about this.
Yeah.
Both approaches are totally valid.
Okay.
He was like, even achieving average returns consistently over time, that's an achievement.
So no shame in the index fund game.
Right.
But even if you're not digging through those financial statements all day,
Yeah.
Graham has some really great insights that can apply to everyone.
Yeah.
And this is where the famous Mr. Market concept comes in.
Ah, yes. Mr. Market.
Mr. Market, what is it? Personifying the market.
Yeah, it's Graham's way of personifying the stock market.
Okay.
It's often irrational behavior.
Okay.
So imagine Mr. Market as this guy, right?
Okay.
Who comes to your door every day.
Okay.
Trying to buy or sell you stocks.
I'm picturing a very pushy used car salesman.
Exactly.
Yeah.
And the thing is, he's totally driven by emotion.
Okay.
Sometimes he's euphoric, and he's offering these ridiculously high prices.
Gotcha.
Other times, he's panicking and practically giving away valuable assets.
So how do you deal with this unpredictable character?
So the intelligent investor, Graham, says, they see through those mood swings.
Okay.
They don't get swept up in Mr. Market's emotions.
Right.
They're focused on the fundamentals, the real value of the businesses behind those prices.
Okay, so let's say Mr. Market's at your door. He's offering to buy your shares in a company you can know worse. But the price is like way too low.
Yeah.
Because he's in a panic. What do?
You smile politely,
Oh, yeah.
decline his offer,
Right.
and you hold on to your shares knowing that they're worth more
Right.
than what Mr. Market is telling you.
Right. You let the fundamentals, not his emotions, guide your decision.
Exactly.
That is a really powerful image.
Isn't it?
Staying rational when everyone else is losing their minds.
Precisely.
All right. That brings us to another one of Graham's core principles.
Oh.
Margin of safety.
Margin of safety.
I'm sensing this is a big one.
This is a big one.
Tell us more.
It's like, think of it as a buffer zone
Okay.
for your investments, right?
Oh, yeah.
It's the difference between what you think a stock is worth
Right.
and what you actually pay for it.
Okay.
And the bigger that margin, the lower your risk.
So you're intentionally aiming to buy at a discount,
Exactly.
even if you're already confident in your evaluation.
It's acknowledging that we can't predict the future perfectly, right?
Yep.
I mean,
And-
think about the dot-com bubble.
Oh, yeah.
Those who stuck to Graham's principles,
Yeah.
they demanded that margin of safety. They avoided those massive losses when everything went,
Kablooey?
Yeah, they refused to overpay.
Okay, so it's like having those
Yeah,
extra pads when you're learning to ride a bike.
I like that.
You might still fall, but you're less likely to get seriously hurt.
Exactly.
That's good.
And, margin of safety isn't just for investing. Think about Captain Sullenberger
Okay.
landing that plane on the Hudson.
Right?
He had a margin of safety, right? That
Yeah.
open water
Right.
allowed him to make a split-second decision when things went wrong.
I never thought about it that way.
Yeah.
That's pretty cool.
So you can see how it goes beyond the stock market.
Yeah. Yeah, I'm starting to see how this could really impact all kinds of decisions.
All right.
But before we get too philosophical,
Okay.
let's get back to the nuts and bolts of investing.
Okay.
Graham was really big on quantitative analysis,
Right.
but did he consider any qualitative factors?
Yeah, he did.
Okay.
But it's important to understand the context of his time.
Right.
So like today's value investors, we look at things like competitive advantage, right?
Yeah.
Management quality and industry trends.
Right.
Those are all qualitative factors.
So it's not just about crunching the numbers, but understanding the story behind the numbers
The story behind the numbers, yeah.
and the people who are running the show.
That's right. Right. And this makes me think of Warren Buffett again. Like he was a huge Graham disciple.
We're huge. Yeah.
But he kind of evolved those core teachings, right?
Absolutely. Yeah.
As his investment style matured.
Yeah. So he started with what Graham called cigar butts.
Cigar butts.
Deeply undervalued companies.
Right.
But often with limited growth potential.
Right.
He was buying them for less than their net asset value,
Yeah.
hoping for a quick turnaround.
So, like a cigar butt has got maybe one good puff left in it.
Exactly. One good puff left in it.
But then as his capital grew, he kind of shifted to these higher quality businesses.
Yeah, he did.
They were still undervalued, but they had more sustainable competitive advantages.
Right.
These were companies he could hold for the long haul.
Yeah.
It's like leveling up in a video game.
I like that.
Yeah.
Yeah.
You start with those smaller wins, and then you move on to those bigger, more complex strategies.
Absolutely.
I like it. Okay, so we're starting to see how those foundational principles
Can be applied in different ways.
Yeah.
As an investor's knowledge and resources grow.
Right.
But before we get into Buffett's evolution,
Yeah.
let's unpack one of Graham's most interesting methods for finding those cigar butt companies.
All right.
All right, we're going to get into that after a quick break.
Sounds good. Welcome back to our deep dive into Benjamin Graham.
Yes.
Last time we were talking about, who Graham was,
Yeah.
his core principles like value investing,
Yeah.
that brilliant Mr. Market analogy,
Yeah, that's good.
even how his margin of safety idea can be used in other areas of life.
Right, right.
And we left off talking about how Warren Buffett started with those
Cigar butt company.
cigar butt company.
Yeah. Deeply undervalued, but maybe not the most exciting businesses.
Exactly. And to find those hidden gems, Graham had this technique he called networking capital, or NWC for short.
Okay. NNWC. Sounds a little intimidating.
Yeah, it does, doesn't it?
Can you break that down for us?
Yeah, so
What is it exactly, and how did he use it to find these cigar butts?
imagine you had to sell off a company's assets tomorrow,
Okay.
right?
Yeah.
And use that money to pay off all its debts,
Gotcha.
whatever's left over.
Right.
That's essentially the company's liquidation value.
Okay.
So NNWC is a way to estimate that.
Okay.
But Graham was super conservative about it.
So it's not just what those assets are worth on paper, but what you could realistically get for them
Right.
if you had to sell them quickly.
Exactly. Like in a fire sale,
Yeah.
in a rush, you might not get full price for everything.
Right.
So he'd take the company's cash,
Okay.
their short-term investments,
Okay.
and then apply discounts to things like inventory
Gotcha.
and accounts receivable.
In case some customers don't pay up.
Yeah, exactly. Or some of that inventory is harder to sell.
Right. So NNWC is like a worst-case scenario valuation
It is.
with some built-in pessimism.
Absolutely. Built-in pessimism.
I like it.
And he figured, if you could find stocks trading for less than their NNWC,
Okay.
you were basically buying them for less than the sum of their parts.
Right.
Even in a really bad situation.
Okay.
He called these nets.
Nets. Okay.
Those were his classic cigar butts.
Okay, so you're buying a company for less than its fire sale value.
Yeah.
Talk about a margin of safety.
Big margin of safety.
Right.
Right.
Yeah.
He was all about minimizing risk.
Right.
And this highlights a huge part of his philosophy.
Okay.
Capital preservation, that was paramount.
Okay, so protect your principal first.
Protect it first.
And then worry about the returns.
Exactly.
Okay, so slow and steady wins the race.
Yeah.
It's not exactly, the sexiest investment advice.
No.
But I'm starting to see the wisdom in it.
It's not about getting rich quick,
Right.
It's about avoiding those big losses that can set you back years.
Yeah.
He famously said, "The essence of investment management is the management of risks, not the management of returns."
Words to live by. I like that.
Right.
Okay, let's say I'm on board with this NNWC thing.
Okay.
Did Graham have any other, specific criteria
He did.
for picking stocks?
Yeah, he did.
Okay.
In fact, in a 1976 interview,
Yep.
he actually laid out
Okay.
some very specific metrics he used.
Ooh, give us the goods.
All right, so
What were these magic metrics?
well, first off, he looked for companies with a low price to earnings ratio, or PE ratio.
PE ratio.
He particularly liked those with a PE below 8.
Okay.
That basically means that the market might be undervaluing the company's earnings.
So not just low, but significantly low.
Yes, significantly lower than average.
Okay.
He was really hunting for those unloved stocks.
The bargains.
The bargains, yeah. He
Okay.
wasn't afraid to go against the crowd,
Right. Right.
And another thing he looked at
Right.
was whether a company's current PE ratio was less than 40%.
Of its highest PE in the past 5 years.
Interesting.
Yeah.
So he was looking for companies that had a track record of being valued higher,
Exactly.
hoping they might bounce back.
Exactly.
Okay.
It's about finding those situations
Yeah.
where the market might be overreacting
Gotcha.
to a temporary setback.
Okay.
And finally, he always looked for companies
Okay.
with a strong financial position.
Okay.
He wanted their shareholder equity
Okay.
to be at least 50% of their total assets.
So a healthy balance sheet.
Yeah.
Solid foundation of ownership.
Exactly, like making sure a house has good bones before you buy it.
Right. I like that analogy.
Right.
Okay. And remember, this was back when information wasn't so readily available.
Right. Yeah.
That's impressive.
It really is, you know.
It's like he laid the foundation for all the fancy algorithms and data analysis.
For all the tools we have today.
That we have today, yeah.
Yeah.
But metrics aside, what about building a portfolio?
Did Graham have any, like, rules of thumb for that?
He did.
Okay.
And some of them might sound pretty familiar.
Okay.
So one, he recommended a portfolio of at least 30 stocks.
Diversification.
Diversification. Don't put all your eggs in one basket.
Right. Classic advice.
Classic advice, yeah.
Okay.
But always good to be reminded.
Right.
He also had a rule for when to sell.
Okay. Tell me about that.
If a stock hadn't hit your target price
Okay.
within 2 to 3 years,
Oh.
it was time to cut your losses
Okay.
and move on.
So no getting emotionally attached
Right.
to a stock just because you own it?
Exactly.
Sometimes you got to know when to fold them.
No one to fold him.
Okay.
And finally,
Okay.
he believed in balancing stocks with bonds.
Okay.
You know, he recommended keeping at least 25%
Okay.
of your portfolio
Yeah.
in a mix of stocks and bonds,
Okay.
with the flexibility to adjust the remaining 75%
Gotcha.
based on market conditions.
So a core of stability with bonds.
Right.
But room to maneuver depending on your risk tolerance.
Yeah.
Okay, that makes sense.
So it was his way of adapting to an ever-changing market.
Right.
And perhaps most importantly,
Yeah.
he stressed that this wasn't a get-rich-quick scheme.
Okay.
He said it could take at least 5 years
Wow.
for this approach to really show its potential.
Patience, young grasshopper.
Patience, exactly.
It's so much of this goes against our,
I know.
instant gratification world.
It does.
But I'm seeing the bigger picture now.
Yeah, it's about discipline,
Okay.
consistency,
Yeah.
letting those principles guide you over the long term.
Right.
But, it's important to remember that even Graham, the father of value investing,
Right.
wasn't perfect.
Oh, really?
Yeah.
Yeah.
Tell me more. His strategies didn't always work as expected.
Okay, what happened? When did his approach seem to stumble?
So a prime example is the late 1990s,
Okay.
the peak of the dot-com bubble.
Yeah.
Remember those tech stocks with sky-high valuations?
Oh, yeah. Everyone was throwing money at anything with a .com in the name.
Exactly. And a lot of value investors, they stuck to Graham's principles.
Right.
They demanded that margin of safety,
Right.
refusing to overpay.
Yeah.
They watched from the sidelines
Right.
as the market went bonkers.
That must have taken some serious willpower
It did.
to, feel like you're missing out on the party.
Yeah, it wasn't easy.
Right.
And some value investors even caved.
Oh, no.
They jumped on that tech bandwagon
Oh,
only to get burned when the bubble burst.
right. So even the best investors
Even the bad.
can get caught up in the hype.
Absolutely.
It's a good reminder to stick to those principles,
Stick to those principles.
even when things seem a little irrational.
Yeah, and you know what?
Yeah.
Even during times when value investing might seem out of favor,
Okay.
there's still opportunities out there.
Okay.
Remember, Mr. Market,
Yeah.
he's always offering up those irrational prices. The key is to recognize them
Okay.
and act accordingly.
So it's not about timing the market.
Oh, yeah.
It's about recognizing those mispricings
Exactly.
and taking advantage of them
Taking advantage
when they arrive.
when they arise.
I like it.
And this brings us to another one of Graham's key lessons.
Okay.
Independent thinking.
Ooh, I like that.
He believed that investors should do their own research,
Oh.
form their own conclusions,
Right.
and not be swayed by the crowd.
So trust your own judgment,
Yes.
not the herd mentality.
Exactly.
Yeah.
Have the courage to go against the grain when you see an opportunity
Right.
that others are missing.
I like it.
As he famously said, you are neither right nor wrong because the crowd disagrees with you.
Okay.
You are right because your data and reasoning are right.
Powerful stuff.
Right.
It's about conviction in your well-reasoned decisions,
Exactly.
even when the market's telling you something else.
Yeah.
Now, we've been throwing around this term intelligent investor a lot. But what did Graham really mean by that?
Good question.
Was he talking about, like, IQ points?
No, no.
Some kind of financial wizardry?
No, he actually dedicated a whole book to this
Oh.
called The Intelligent Investor.
Okay.
And what's fascinating
Yeah.
is that he said,
Yeah.
being an intelligent investor
Yeah.
is more about temperament
Okay.
than intellect.
Whoa, that's a twist.
Yeah.
So it's not about being a math genius.
No,
It's about having the right mindset.
the right mindset.
Okay.
He believed that the most important qualities for investors
Right.
are patience, discipline, independent thinking, a willingness to learn,
Yeah.
and especially emotional control,
So mastering your own psychology.
your own psychology.
Not trying to outsmart the market with algorithms.
That's right.
Okay.
Remember Mr. Market?
Yeah.
He's always trying to get you to react emotionally.
Right.
The intelligent investor recognizes that and stays calm.
It's like being a Jedi master of investing.
I love that analogy.
You're not letting fear or greed cloud your judgment.
That's right.
Okay.
It's about recognizing those emotions,
Yeah.
not letting them dictate your actions.
We've talked a lot about Graham's approach to finding undervalued companies.
Like you have.
But what about those high-growth companies?
Yeah.
Did he have anything to say about them?
You know, that's a great question.
Yeah.
And it brings up a really interesting point
Yeah.
about how value investing has evolved
Okay.
since Graham's time.
Right.
He definitely acknowledged the potential of
Right.
growth stocks,
Yeah.
but he was also wary of them.
So he wasn't totally against them,
No.
but he approached them with caution.
With caution, exactly.
Okay.
He felt valuing them was inherently trickier.
Yeah.
You know, their high valuations,
Yeah.
they left very little room for error.
Right.
It was harder to find that margin of safety.
So he wasn't saying never to growth stocks,
Right.
but more like proceed with extreme caution.
I think that's a good way to put it. He understood that the market can get carried away,
Right.
you know, with those growth stories
Right.
and overprice those companies.
So how did he reconcile that
Yeah.
with his value investing philosophy?
It's interesting.
Yeah.
In his book, Security Analysis,
Okay.
he actually dedicated a whole chapter
Go ahead.
to valuing growth stocks.
Okay.
But in later editions, he removed it.
Whoa, that's telling.
It is, isn't it?
Why do you think he did that?
It seems like his views on growth investing evolved.
Okay.
You know, in a 1976 interview,
Yeah.
he actually said he was skeptical
Okay.
about reliably valuing growth stocks.
Gotcha.
He felt there was just too much uncertainty.
So even the father of value investing
Yeah,
wrestled with the challenges
he did.
of growth stocks.
Yeah.
I feel better knowing we're not alone
You're not alone.
in grappling with that. Yeah.
You're not alone.
It brings up a good question, though.
What's that?
Can you be a value investor and
Yeah.
still invest in growth companies?
Right. It doesn't have to be either.
Right.
Is there a way to bridge that gap?
Right.
There absolutely is. In
Right.
fact, many successful investors today
Yeah.
have done just that.
Okay.
They've taken those core principles
Yeah.
of value investing
Right.
and applied them to a world where growth is increasingly important.
So this is where Buffett comes back into the picture, right?
Exactly. Remember how we talked about him starting with those cigar butts?
Yeah.
As his capital grew,
Yeah.
he shifted to companies with higher growth potential,
Okay.
but he still insisted on those core principles:
Yep.
intrinsic value,
Yeah.
margin of safety, and capital preservation.
So he leveled up his approach.
I think that's a great way to put it.
Yeah. Applying those principles to a different type of company.
Right.
It's almost like he found a way to blend the best of both worlds.
Yeah, he did.
I like that.
And it really shows the adaptability
Okay.
of Graham's teachings.
Okay.
They're not just rigid rules,
Right.
but a flexible framework.
It can be applied in different ways.
This is blowing my mind.
Isn't it fascinating?
It really is.
Yeah.
It's like his legacies continue to evolve
It has.
and grow
Uh-huh.
beyond his own lifetime.
Right.
His ideas have sparked a whole movement in the investment world.
That's a perfect way to transition to our final segment.
Okay, let's do it.
We'll explore how Graham's legacy continues to shape investing today.
Okay.
And we'll leave you with some final thoughts to ponder
I like it.
as you embark on your own investing journey.
Sounds good.
Stick with us.
All right, so welcome back to the final part of our Benjamin Graham deep dive.
Yeah, it's been a journey, hasn't it?
It really has. We've talked about his core principles, his stock picking strategies.
Oh, yeah.
Even how his idea of the intelligent investor is more about mindset than like being a math whiz.
Totally. Yeah.
But now I'm thinking, like, how do these ideas actually play out in today's market?
Right.
You know, are they still relevant in our crazy, fast-paced world? Well, his impact is huge.
Okay.
Even if people don't realize it.
Yeah.
So one obvious example is the rise of index funds.
Okay.
Graham himself was a big proponent of those for the defensive investor.
Right. Yeah. If you didn't want to spend your time researching individual stocks, you could just buy a diversified basket of them.
Yeah.
Like an index fund.
Exactly.
Tracking the S&P 500.
That's right.
That was a solid strategy.
Absolutely.
And today, they're everywhere.
Oh, yeah.
It's one of the most popular ways that people invest.
Yeah, it's gone totally mainstream.
Right.
Yeah. But beyond index funds, you see Graham's influence in the strategies of so many value investors.
Okay.
We talked about Buffett.
Yeah.
But there are others, Seth Klarman,
Yeah.
who focuses on distressed assets.
Yeah.
John Marie Avillard, who's
Right.
known for his global value approach.
Okay.
They're all building on that foundation that Graham laid.
Okay, so it's not just individuals. It's like whole investment firms
Yeah.
built around his teachings.
Right.
Okay.
Teams of analysts.
Yeah.
Living by security analysis.
Right?
Searching for those undervalued companies.
So he's not only stood the test of time, but his ideas are being applied at a huge scale.
Yeah, absolutely. Yeah.
Impacting like billions of dollars in investments.
Yeah.
That's incredible.
It's a powerful legacy.
It really is.
It goes beyond just those professional investors too, right?
Oh, okay.
His books, The Intelligent Investor,
Yeah.
still bestsellers.
Okay.
They're educating everyday people
Yeah.
about investing.
It's like he democratized investing.
He did.
Gave regular people the tools and the knowledge to make their own financial decisions.
Exactly.
Cool like that.
And you know, we keep coming back to this idea of applying his principles beyond just the stock market.
Right.
Remember we talked about Captain Sully
Yeah.
and his right of safety?
On the Hudson. Yeah.
On the Hudson.
What are some other examples
Okay, so
of how these concepts translate to other parts of life?
so think about relationships.
Okay.
Right. Applying a margin of safety there might mean choosing partners who are financially responsible, who share your values, right?
Okay, so you're not just looking for someone fun to be around.
Oh, no. Yeah.
But someone who's going to be stable and reliable.
Reliable over
for the long term.
Thinking long term.
Okay.
Just like investing.
I like it.
Or consider career choices.
Okay.
Right? Margin of safety there
Okay.
might mean choosing a field that's stable,
Okay.
resilient,
Okay.
even if it might mean a slightly lower starting salary.
So you're prioritizing job security and long-term
Yeah.
prospects
Long term.
over that high starting salary.
Yeah.
Okay. Right.
Right.
It's a different way to think about it.
It is.
I like it.
And you could even apply it to personal well-being.
Okay, how so?
So margin of safety there might mean focusing on preventive care,
Okay.
getting enough sleep,
Okay.
managing stress.
So building in those healthy habits
Healthy habits.
to prevent problems down the road.
Exactly.
I love this idea.
It's all about making choices that build resilience
Okay.
and reduce your vulnerability
Right.
to negative outcomes.
Wow, that's powerful.
It's a mindset shift.
It really is.
That can be incredibly powerful.
This is amazing. Who knew that a deep dive into investing could lead to such profound insights about how we live our lives?
Right. And that's the beauty of Graham's legacy.
Yeah.
His teachings go way beyond just picking stocks.
Right.
They offer a timeless wisdom about making better decisions,
Oh.
managing risk, building a more secure and fulfilling life.
So as we wrap up our deep dive
Yeah.
into the world of Benjamin Graham,
Right.
we want to leave you with a final thought.
Okay.
How can you apply this margin of safety concept to your own life?
That's a good one.
Right. Your relationships, your career, your health,
Right.
anything else.
Yeah.
Challenge yourself to think about how building in that extra buffer,
Yeah.
that protection against the unknown,
Right.
can lead to greater resilience and a more secure future.
It's definitely worth pondering.
It is, and it's a testament to the power of his ideas that they're still sparking conversations
Yeah, absolutely.
decades after he first shared them.
It really is.
So thank you for joining us on this deep dive into Benjamin Graham.
Yeah, thanks for listening.
We hope you learned something new
Yeah,
and gained a newfound appreciation for the principles of value investing
absolutely.
and how they can apply to life.
To life in general.
And remember, as Graham said, Being an intelligent investor
Yeah,
is a journey
it is.
of continuous learning
It is.
and adaptation.
Adaptation.
Stay curious,
Save discipline.
stay
It's a
disciplined,
discipline.
and never stop seeking those opportunities for growth and value.
That's right.
Until next time, happy investing. Hey everyone, welcome to a deep dive into the world of value investing. So, you're interested in getting a solid grasp on Benjamin Graham's principles. Well, we've got some great articles and excerpts ready to break it all down for you.
And you might be surprised at just how relevant these principles are, even today.
Yeah, like, did you know even Captain Sully used a version of Graham's margin of safety?
It's true. And you might even be leaving money on the table by not using these techniques, so let's dive in and find out.
All right, sounds good. So, we have to start with the man himself. Benjamin Graham, you can't really talk about value investing without mentioning him, right?
Nope. He's considered the father of value investing for a reason. Not only did he basically invent security analysis, but he really pioneered this whole philosophy of value investing. And it wasn't just theory for him, you know?
He actually put it into practice.
Yeah, his firm, Graham Newman, consistently outperformed the market, which proved that his strategy could win in the real world.
So he was walking the walk, not just talking the talk. I'm seeing this theme of self-awareness pop up a lot in the material you sent me.
Oh, Graham was big on that. He believed that before you even think about picking stocks, you have to understand what kind of investor you are, you know? Like, what are your strengths, your weaknesses, your limitations?
Interesting.
He even had these categories: enterprising and defensive investors, which basically map to what we call active and passive investing today.
Oh, okay. And he also had a pretty interesting take on risk and return, too.
Yeah, totally. He kind of flipped the traditional idea on its head. So instead of accepting the higher the risk, the higher the potential return, he was more about work equals return.
Work equals return.
Yeah, so he believed that the more research and effort you put into understanding a company, the better your chances of beating the market.
Okay, that makes sense. But he wasn't totally against passive investing, was he?
No, not at all. He totally acknowledged that not everyone has the time or even like the desire to just dive deep into company financials. He even suggested that defensive investors could do okay by just simply putting their money in an index like the Dow Jones, so kind of like today's index funds.
Yeah, interesting.
But, you know, he was realistic about it, too. He warned against thinking you'll magically get above average returns without putting in any effort. He thought most people who tried to game the system that way would probably end up underperforming in the long run.
Okay, so no free lunches. All right, so let's get into the meat of it. The core principles of Graham's value investing approach. And I guess we'll start with intrinsic value. What exactly is that?
So you can think of intrinsic value as the real worth of a company. Stripped of all the market hype and all the noise, it's like figuring out what a house is truly worth based on its location, you know, size, condition, not just what someone might list it for on a whim.
Right.
And you get to that intrinsic value by doing fundamental analysis, digging into the company's financials, their dividends, pricing structure. You really got to understand its true earning power. And this sets value investing apart from those strategies that just chase trends or get swayed by hype.
So it's more about looking under the hood than just glancing at the sticker price.
Exactly. And once you've got a handle on that intrinsic value, that's when you bring in Graham's famous margin of safety.
Okay, I've heard about this, but can you break it down for me? It's all about minimizing risk, right? Like having a backup plan.
That's a great way to put it. So the margin of safety is basically the difference between a stock's intrinsic value and its market price. It's like a built-in cushion to protect you from potential losses. So let's say, imagine you found a house that's worth $300,000, but you can buy it for $250,000, that $50,000 difference.
Yeah.
That's your margin of safety. So if the market takes a dip or your initial assessment was a little off, you've got that buffer to kind of absorb the shock.
Okay, now that makes sense. But how do you actually calculate that margin of safety when you're looking at stocks?
Okay, so let's say you're looking at, I don't know, a company called Techco. And after doing all your fundamental analysis, you estimate their intrinsic value is, let's say, $50 per share.
Right.
But Techco is currently trading on the market for only $35 a share.
Okay.
That $15 difference, that's your margin of safety.
Got it. So the bigger that difference, the safer the investment, potentially.
Right. A wider margin of safety generally means you're getting a better deal and you have more room for error in your valuation. Of course, you also have to consider other factors like the company's growth prospects and overall market conditions, but the margin of safety is a key piece of the puzzle.
Absolutely. Okay, so we've covered intrinsic value, Margin of safety. What else is there? What else is in Graham's toolbox?
Well, you can't talk about Graham without mentioning his famous analogy, Mr. Market.
Mr. Market. Who is Mr. Market?
So Graham imagined the market as this like quirky, emotional character who shows up at your door every day offering to buy or sell stocks.
Okay.
But the catch is that Mr. Market is super moody. Sometimes he's wildly optimistic, other times he's downright pessimistic.
Sounds unpredictable.
He is. He's often driven by fear and greed rather than logic.
So, sounds like someone I wouldn't want to take investment advice from.
Right. But Graham's point is that you shouldn't let Mr. Market's mood swings dictate your decisions. Instead, use his irrationality to your advantage. So when he's feeling down and offering stocks at bargain prices, that's your chance to buy.
Okay.
And when he's like overly excited and driving prices sky high, that's when you consider selling.
So it's about keeping a cool head, even when everyone else is losing theirs.
Exactly. Mr. Market is always going to be emotional, but you don't have to be. Successful investing is about thinking long-term and not getting caught up in the daily drama.
So we're playing the long game, not trying to time the market. Now, along those lines, there's also the contrarian approach that Graham was known for.
Right. Value investing often involves going against the crowd, buying when others are fearful and selling when everyone else is feeling, bullish.
Yeah.
This can be really tough psychologically, but it's often where the biggest opportunities lie.
Interesting. Okay, so far we've gotten a great overview of Graham's core principles. Finding the intrinsic value, buying with a margin of safety, keeping our emotions in check with Mr. Market, and having the guts to be contrarian. I'm already starting to see how powerful these ideas can be. But how have they stood the test of time? What about the modern market?
That's a great question, and that's what we'll dig into more in the next part of your deep dive.
Okay.
We'll explore how modern investors have built upon Graham's foundation, how his principles apply in a globalized world, and even look at some real-world examples of value investing in action.
Sounds good. I'm ready to keep going. So we've got this foundation of Graham's core principles, but the market's always changing, right? How have those ideas kind of evolved, and how can we actually put them to work today?
Well, one thing that's really interesting is how Graham's work has been kind of built upon and expanded. Like, he focused mainly on those hard numbers. But modern value investors have also added in qualitative factors.
What kind of factors?
Like, they look at things like a company's competitive advantage, which you'll sometimes hear called a moat. The quality of its leadership and even like broader industry trends.
So it's not just about crunching the numbers anymore. You have to kind of understand the bigger picture, the story behind the numbers.
Exactly.
Okay, that makes sense. Now, what about going global? Can Graham's principles work in markets all over the world?
Yeah, definitely. But you have to be really aware of things like political instability and currency fluctuations. Those risks can be super different depending on the country.
Right.
And accounting standards aren't universal either. So you might need to adjust Graham's metrics a bit depending on, where you're investing.
Yeah, makes sense. A reminder that investing, especially internationally, takes careful research and a willingness to adapt.
Absolutely.
Okay. Now, I'm really curious to see how all this actually plays out in the real world. You mentioned Warren Buffett. He's like the poster child for value investing, right?
It is. He was super influenced by Graham, especially by that whole idea of margin of safety. And his track record with like Coca-Cola really shows the power of Graham's teachings. Buying undervalued stocks with solid fundamentals and then just holding them for the long term.
So like this student who became the master.
Exactly.
Are there other value investing rock stars out there that we should know about?
Oh, absolutely. Seth Klarman, he wrote a book actually called Margin of Safety. He's another great example. He's known for finding these like undervalued and kind of distressed assets like the cigar butt investments that most people overlook.
Oh.
He had this awesome success story with Idenix Pharmaceuticals. So he basically figured out that the company was worth about $1 billion, but he managed to buy a 35% stake for just $107 million.
Wow.
Almost a 70% margin of safety.
That's huge. What happened?
So a few years later, Merck came along and bought Idenix for $3.85 billion. Klarman's investment basically increased tenfold.
Oh, wow. That's a seriously impressive return. But, I mean, things have changed a bit since Graham's time, haven't they? How has value investing kind of adapted to the modern market?
That's a really key question. It's interesting to, compare how Graham and Buffett approach things. Early on, Graham was very focused on these cigar butt investments, finding extremely undervalued companies that were often struggling and then profiting from a short-term turnaround.
Yeah, kind of like finding a discarded cigar with just a few puffs left.
Exactly. The ones that everyone else thinks are worthless. But Buffett kind of changed things up a little bit.
How so?
So as he gained more experience and his portfolio grew, he shifted his focus. He started looking for higher quality companies that had these lasting competitive advantages, the kind that he could just hold for years, even decades. He's famous for saying that his favorite holding period is forever.
Wow, that's commitment.
It is. So it's not just about finding like a cheap stock. It's about really understanding the quality and the long-term potential of the underlying business.
So quality over just a bargain.
Right. And, while the specific metrics that Graham used might need some tweaking in today's market, his core principles are still incredibly relevant. There's even research showing that both like low quality value stocks, more like Graham's original style, and high quality value stocks like the Buffett approach can actually outperform the market.
Interesting. So there's room for both. It's more about like understanding the nuances and finding what works best for you as an investor.
Exactly. And, while some people think that those classic cigar butt opportunities are harder to find today, there's also an argument that Graham's emphasis on having that large margin of safety is even more important now. With the global economy being so complex and everything interconnected and the potential for those like unexpected events.
Right.
Having that buffer can really help you weather the storms.
Makes total sense. Okay, so we've covered a lot of ground. Graham's core principles, how they've evolved, how they've played out in real-world success stories. But before we get too excited and just start picking stocks, are there any potential pitfalls or challenges that we should be aware of?
Oh, definitely. I think one of the biggest challenges is actually our own emotions. Value investing often means going against the crowd, buying when others are panicking, and having that patience to wait for the market to catch up and recognize the true value of a company.
Yeah.
And that can be really tough psychologically, especially when you see others kind of like making quick profits with totally different strategies.
So it's not just about having the right knowledge, it's also having the right mindset.
100%. And you also have to be careful about falling into what are called value traps. Sometimes a stock looks cheap for a reason, like the underlying business might be facing some serious challenges that aren't immediately obvious. So you can't just chase low numbers. You have to really understand why those numbers are low.
So a little bit of caution and due diligence. Even when we think we found a bargain. What else?
Well, even though value investing is all about the long game, it's easy to get caught up in this temptation to try and time the market, like predict the perfect moment to buy or sell.
Oh, yeah, I've definitely been guilty of that. It's so hard to resist the urge to try and like outsmart the market.
Right. But the problem is that even the pros have a hard time consistently timing the market. Graham himself knew that it was basically a fool's errand. He thought it was way more effective to focus on just finding those undervalued companies and letting the market do its thing over time.
So instead of being like a fortune teller, we should be more like gardeners, planting seeds and patiently waiting for them to grow.
Exactly. And lastly, I think it's important to remember that there's no one-size-fits-all approach to value investing. What works for one person might not work for another. So your circumstances, your risk tolerance, your goals, even your personality, all of that should factor into how you actually apply Graham's ideas.
That makes sense. It's really starting to sound like value investing is more than just a strategy. It's like a personalized philosophy for navigating the market.
You're totally right. Graham's principles give you like a framework, but you get to kind of build on that framework, adapt it to your own situation, and really develop your own version of what he called the intelligent investor character. That's what's going to lead to long-term success.
I love that. So we've come to the end of our deep dive. We started by exploring those core principles of Graham's value investing strategy, looked at how they've evolved and how they've played out in real-world success stories. But now, where do we go from here? How can people listening actually put all of this into practice?
Well, a good starting point is actually just reading Graham's book, The Intelligent Investor. I mean, it can be a little dense, but it's full of like valuable insights. And of course, there are tons of other books and articles and, online resources that are all dedicated to value investing.
I've also heard about investment clubs too. Are those a good way to learn and connect with other value investors?
Absolutely. Investment clubs and online communities are great places to exchange ideas, get feedback, and kind of learn from each other's experiences.
Now, before we wrap things up, I'm kind of curious to get your take on something. We've seen how value investing has evolved, over the years. What do you think the future holds for this approach?
That's a great question. I think at its core, value investing is about these timeless principles that will always be relevant. The specifics might change, new metrics might come along. Technology is definitely going to continue to shape the investing landscape, but that fundamental idea of finding those undervalued assets with a margin of safety, that's going to be valuable no matter what.
So it's not about predicting the future. It's more about understanding the principles that kind of drive market behavior over the long term.
Right. And I think in a world that's like obsessed with short-term thinking, algorithmic trading, and, just information overload, Graham's emphasis on patience, discipline, and independent thinking is going to become even more valuable.
That's an inspiring thought. It's really reassuring to know that in a world of constant change, there are still those timeless principles that we can rely on.
Absolutely. And I encourage everyone listening to keep exploring Graham's work, dive deeper into value investing, and most importantly, start your own journey of becoming an intelligent investor.
Couldn't have said it better myself. Thanks for joining us on this deep dive into the world of Benjamin Graham and value investing. Until next time, it really does sound like value investing is like way more than just a strategy. It's almost a whole philosophy of life.
Yeah, I think you're right. I think Graham, even with his reputation for being this like numbers guy, would agree with you on that. His focus on character, on keeping your emotions in check, making sure that like your investments align with your values. That kind of speaks to a much broader philosophy, one that goes way beyond just picking stocks.
We've covered a ton of ground in this deep dive. We talked about the principles, the strategies, even that philosophy of value investing. So for our listener, what's the one big takeaway you'd want them to remember?
I think if there's just one thing they take away from this whole deep dive, it's don't be afraid to be different. In a world where everyone's always chasing the latest trends and wanting instant results, value investing requires you to be a bit of a contrarian. You got to think independently, have a long-term vision, and be willing to often go against the grain.
I love that. Sometimes the best opportunities are the ones nobody else is paying attention to.
Yeah.
Now, before we wrap up, I have a little challenge for you listening. We've been talking about value investing and, the stock market. But what if you took these concepts and kind of applied them to other parts of your life?
Whoa, that's a fantastic idea. Imagine like using that margin of safety concept when you're making, I don't know, career decisions or thinking about relationships or even setting personal goals. What would it look like to like build in some buffers, consider different paths, and make decisions with more of a long-term perspective?
Ooh, that's something to really think about. We've uncovered so much in this deep dive. Started with those core principles of Graham's value investing strategy, compared with other approaches, and even looked at some real-world examples of its success. We also talked about how those timeless ideas can be applied in today's market and even beyond just the world of investing.
Yeah, and honestly, you've only just scratched the surface. I encourage you to keep exploring Graham's work, dive deeper into value investing, and most importantly, start your own journey of becoming an intelligent investor.
Thanks for joining us on this deep dive into the world of Benjamin Graham and value investing. Until next time.